Chapter 26 addresses capital investment decisions. This is a topic that we will share between Principles of Accounting and your business financial management class. So although you will look at capital investment decisions in detail in your finance class, I would like to introduce you to the overall concept of capital budgeting in our Principles class. So we're going to look at a couple of different things. We're going to look at why capital budget is different than the master budget and operating budget that we have looked at in previous chapters and why it's important to an organization. We'll look at a couple of tools that are used in the capital budgeting process, such as the payback method and the rate of return on making capital investment decisions. And then we will look at some tools that actually utilize the time value of money to calculate the present value of lump sums and annuities when we're considering potential large outflows of cash when we acquire property, plant, and equipment. And we're also anticipating the cash inflows, revenues, or cost savings as a result of purchasing property, plant, and equipment. So we'll also look at some of these, the use of time value of money in the discounted cash flow methods to analyze how we can use a combination of these tools to determine when our organization should make capital investments. We have to understand what those capital investments are in order to understand the importance of them and how we should analyze that decision-making process. So we'll do that in Learning Objective 1. So if you remember from your financial accounting course, we talked about the different kinds of assets. And one of those is a capital asset, property, plant, and equipment. These are operational assets that are used over a long period of time, 3, 5, 7, 10, 14, 35 years. And so we call these assets capital assets because they are capitalized. That means we put them on our balance sheet as a capital asset and we depreciate them over their anticipated useful lives. And so once again, just to give you an overview of how those capital assets tie to the managerial side of accounting that we are discussing, when we depreciate that property, plant, and equipment that is used in the manufacturing process, it ends up in our manufacturing overhead account. And then depending on which predetermined overhead allocation method we have used, a single wide rate or a ABC costing, we will allocate that depreciation to the manufacturing process. So it eventually ends up in the cost of our goods manufactured, and it flows from there into cost of goods sold on the income statement. But we also have property, plant, and equipment that's used in the selling and administration process. And that property, plant, and equipment is also on our balance sheet. It's also depreciated, but that depreciation expense that is not tied directly to production simply goes to depreciation in the income statement as part of our selling and administrative expenditures. So just an overview, a catch-up for how these capital assets are recorded in our balance sheet, and the depreciation moves those expenses eventually to the income statement. We're going to look at, after understanding what they are, we're going to look at what is involved in the acquisition of these assets. They are significantly more expensive than daily operating expenses, and so they require a significantly larger amount of cash outflows, and especially at the beginning when we make the purchase. So we have to do some detailed analysis on whether it's truly viable for us to make such a large investment. So we're going to utilize capital budgeting. Okay, so planning on when and how to invest in these long-term capital assets that hopefully will generate a return and be profitable to our organization. So your book gives you a breakdown of this process that we have seen before in our operational budgeting, that we develop strategies, we plan, we act upon them, then we control what's going on. Well, this development of strategies is the same in all of these budgets. We have to have long-term strategies and long-term goals in order to plan our long-term investments, in order to plan our daily operations. And so even though this doesn't change, the second part, or planning in our budget, does, because now we have to identify those potential capital investments that we need, whether it's an expansion, a completely new retail store, or a new division, or do we need new equipment? Do we need to simply refurbish? Do we need to purchase new? And so, and over what period of time? Union had to do this with our expansion of the dormitories and our new buildings. So this wasn't just a decision that was made overnight after the tornadoes to expand our campus. We had a 2020 plan in line that included the expansion of the campus, the expansion of buildings and dormitories. Now, sometimes we have events such as the tornadoes and natural disasters that can either slow down our investment process, or in the case of Union University, kind of implemented that plan before it had been anticipated. So having a plan in place helps us to identify these potential capital investments and then to analyze the things that we need, the data that we need to consider before we determine maybe which property, plant, and equipment should be acquired. And then we act upon these investments, make those investments, and we also are going to have to control them. Just as we were controlling the operational budgets, we're going to have to compare what we thought our return in the investment was going to be with what it actually is. Unfortunately, if we're not meeting our planned return on investments for property, plant, and equipment, it's not as simple as trying to find areas in the operational budget where we can cut back or be more efficient. It's one of those where we have to consider, do we completely abandon this project as a result of poor return? So we're going to look at this in detail as we move on through your chapter. Let's look at the capital rationing that has been shared with us. We have a couple of different methods. I'm going to skip down a slide here to see those. We have a couple of different methods that we can use in the budgeting process. One is the payback method, and the payback method simply walks us through how long will it take me to recoup or recover the amount of cash that I have invested in this particular piece of equipment or this particular capital asset. The accounting rate of return looks at how much return we are generating from our accrual income as a result of these investments. So both of these are very useful tools in the capital budgeting process. They're probably the two easiest to calculate, the easiest to analyze. However, they're not very detailed analysis of our decision making. And one of the reasons is because they do not consider, remember the capital investments are long-term investments, these two methods do not consider the present value or the future value of our cash flows. And that's going to be significant in the long run. Now we also have the net present value and the internal rate of return methods that we can use. And these two methods do take into consideration the net present value of our cash flows. So as your book talks about the capital rationing process, this may be a procedure where the organization has 4 to 6 different capital investment plans that we are considering, and we may use the first two methods, the payback method and the accounting rate of return, to eliminate the options that are a little less desirable. And so if we can actually get down to the top 2 or 3 investment decisions, then we may use the last two methods that we discussed here, net present value and internal rate of return, to finally analyze maybe all 3 of these are good investment decisions that we are considering, but I have to ration and decide which one can I invest in now versus which one do I need to invest in later. Okay, and so it would be nice if we had an unlimited amount of resources and we could simply invest in any capital investment project that we need, but that's usually not the case. And those of you who are in marketing and you are part of an organization that is selling property, plant, and equipment to an organization. My husband is an engineer. He does this. They sell robots and very high capacity a computerized conveyor systems, and what they run into in their sales process is that this is not a quick decision that a company can make. It has to be part of their capital budgeting decision. It has to fit in their budget, and so it may take a year or two to close a sale with an organization when you're selling property, plant, and equipment that has such a large initial cash outflow for the purchase. And so it doesn't mean that that investment may not take place, but it's going to take a lot of analysis before it does. And then finally, we're going to look at a post-audit. As we mentioned, we're looking at the comparison of the actual return of investment, the actual payback that is taking place, to what we have projected to determine if we can actually continue with this investment as we have discerned it from the beginning, and does it impact some of the future investments that we had on hold that we had not actually approved of yet. So once again, the methods that we'll look at: payback and the accounting rate of return initially, and then we'll look at the net present value tables to look at NPV and internal rate of return. So, as we said, there are a couple of stages in capital budgeting. We're going to look at all those potential investments using one, two, or all four of the methods that have been recommended for us. We may, once we've screened our investments using the payback method or the accounting rate of return, if we have vetted them down to the top investments, we may use the internal rate of return or net present value methods to further break that decision making down. And we also want to focus on cash flows, right? So in the operational budget, we're looking at variances. How did our revenues, expenses, profit vary from what we anticipated it should be? Well, in the long-term budgeting process and in capital investments, we're looking more at cash flows. And so what do we mean by that? We're going to look at cash inflows, and we're going to look at cash outflows. And so what we're primarily, the difference in these, this is not just income, this is cash flows. And so before we consider an investment, we want to know if that property, plant, and equipment is going to generate revenues, okay? Because we have to pay for it in some way. Hopefully it is generating revenues, but also we want to look at, yes, this is an inflow, savings. Okay, because if this machine is more efficient, if it requires less material, it requires less manpower, it requires less maintenance, those are cost savings, and that is cash flow that I am holding on to. And it kind of goes back to somewhat of a relationship to our short-term decision making in the prior chapter. What is the difference? Okay, what information is relevant in this decision-making process? So if I am spending a significant amount of maintenance on an older machine and I can cut my maintenance cost by 75% with an investment in a new machine, this is considered a cash inflow because it is cash that is no longer going out to maintenance. So the primary cash inflows are the revenue generated from the piece of equipment, the savings that I will generate as a result, and then we have residual value. So we need to be good in our estimates here. If I purchase a piece of property, plant, and equipment that should last for 7 years, will it have any residual value at the end of those 7 years? Do you remember what residual value is from your financial class? Okay. So if I purchase a 7-year piece of equipment for $100,000, but at the end of 7 years, I think it will still have a $10,000 value. I could sell this piece of equipment for $10,000. That's my residual value. So that is also a potential cash inflow. When we're looking at cash outflows, well, obviously the largest one is going to be my initial investment. What cash am I going to use to make this initial investment? And then we're going to have our additional operating costs. There are going to be some cost of operating this asset, and I need to know what that's going to be. It's going to be an estimate. And I also need to take into consideration refurbishment, repairs, and maintenance on this piece of equipment. So as we are going through our analysis, we're going to look very strongly at cash inflows, cash outflows. We're going to look at this will help us to determine the payback period. It will also help us when we're trying to determine what is the net cash what is the present value or the future value of the cash flows that I'm going to incur in this process. Now, as we're making these decisions, we're going to separate these initial investment outlays of cash from our other cash flows that are taking place as a result of operations. So these are going to take place regardless of what I spend on my initial investment. So we will hold these things separate as we were moving through our analysis decisions, just to make you aware of that. So we can see the life cycle from the acquisition of the asset, our cash outflow, the usage of our asset, and then eventually the disposal if it has a residual value. And so we can track those cash flows, the initial outflow that we spend, the revenues that we are generating, and the daily operating costs as we move through our manufacturing process. And then eventually, if I do dispose of it, does it have a residual value? So these are things that are all going to be important to us in just understanding the capital budgeting process. So if you want to take a break, look through your book, make some notes, we're going to come back and begin our next discussion actually utilizing the payback method and the accounting rate of return to analyze some different capital investment decisions.